everyone, and thank you for joining Metaverse Express Full Stop, where we hit the brakes to discuss hot topics in the metaverse. My special guest today is Clinton Donnely from Crypto Tax Audit. Clint's been doing crypto tax returns, I learned, for a while now. I think since 2018. He's going to tell us about that. But since then, you've expanded the services. Now, Crypto Tax Audit is also defending people who are being audited by the IRS, which we're going to talk about in the upcoming episodes. Why I'm so excited you're here today to share your wealth of knowledge with my non-crypto native audience and bring some clarity to this very misunderstood topic of crypto taxes. So welcome to the show, Clint.
It's a real pleasure to be here, Mona. It's a pleasure to talk about crypto taxes. I've been doing crypto taxes since, starting in 2018 for the 2017 tax year. And since then, I've been on the Crypto show, Ivan on Tech. Some of the largest crypto traders in the US are my clients. I have clients in 71 countries. People bring us their toughest challenges, which is why, large accounting firms, some of the largest accounting firms work with us to do reporting for their clients. So I'm excited to be on your show and talk about this important topic for your clients.
Let me have the viewers understand how hard it is. And it was for me to find someone like you. And had I not been to events and see you speak on stages, there are not a lot of experts out there who understand the crypto taxes at this level and who are able to educate. So I just want to let people know you are a gem. you are a gem, and I'm just glad you're here. And we can do this today. And actually, people don't know, we tried to do this yesterday, but I was having technical difficulties. But what we realized yesterday, and I'm glad we had the conversation, was that we're gonna split this conversation into two parts. So today, Clint's gonna set the stage for us on how crypto is taxed today and how you can't escape crypto taxes. Just like when I say you can't escape death and taxes, you can't escape crypto taxes either, guys. But then next week, we're going to go a few layers deeper, and we're going to talk about crypto gains, crypto losses. Maybe we'll talk about that today if we have time. But we're also going to talk about tax evasion. We're going to take it a few notches up. Clint is going to talk to us about some of the flaws in centralized exchanges and how taxes are calculated there, which was fascinating when you were talking to me about it yesterday. So I'm really excited to talk about that. So thank you again for being here today and educating us. But before we get started, I want to give you the opportunity to tell the viewers a little bit about yourself and your crypto journey.
Well, thank you very much, Mona. As I mentioned in 2018 and how we've just grown at this point in time, I have a company of over 20 employees, several CPAs. I have a law degree. We have enrolled agents and other legal specialists in the company. We, as a company, cryptotaxaudit.com, we prepare tax returns using a bulletproof methodology. We calculate people's crypto gains. I mean, we've had people with 5 million transactions, people with 75 wallets. Nothing's too complex. And we have just an excellent, repeatable accounting process for doing that reconciliation. But we've taken it a bit further in that we actually defend people in IRS audits of their cryptocurrency. I mean, it's one thing to go to the medical school and learn all about the body, but it's another thing to actually cut it open and start to do the work. And that's the difference that I think I bring over all my competitors, really. I've defended 40 audits before the IRS. Some of them have gone really smoothly. We've gotten refunds in 30% of these times, which is unheard of. But some of them, the IRS is a dogfight with them, and we're having to take them to the tax court.
Wow, I can only imagine. I can only imagine. I'm excited to talk about that next week. I mean, as you mentioned, we haven't had, clear set of guidelines in the past few years on how to do crypto taxes. In fact, I remember you mentioned when we were speaking yesterday, Gemini Research came out and saying only 8 million it's 33 million, right, of crypto owners have said yes to digital currency on their tax return. Is that correct?
So Gemini Research said there's 33 million crypto owners in the US. In tax return processing this past year, the IRS has come out with preliminary numbers which indicate about 8 million crypto said yes to the virtual currency question on the return. So that suggests that 25 million or roughly 70% of all crypto owners are answering no to that question, which might be a mistake, might be that they're trying to hide from the IRS, might be they're not even filing a tax return. That's a really high percentage. It's a very disturbing percentage, and which is to suggest that possibly 70% of the people listening to this talk today may be in that
are going to jail. You guys we're all going to jail, everybody. This is awesome. No, it's concerning. This is a crisis, right? Yes. This is a tax crisis.
This is a tax crisis, and it's the reason we have this crisis primarily is ignorance. People didn't know that they had to pay taxes on crypto transactions. They talked to their tax advisor, a CPA, an accountant, and those people didn't understand what to do. And they might have used some of these online crypto gain calculation services, and they were very confusing and left them in a very frustrated spot. And so they might have just thrown their hands up and not reported anything. Next year comes, you just never report, and you're in this really dark, downward spiral of non-reporting. So yeah, so we'll talk about that next week. We'll get into that.
Absolutely. And I'm so glad that people like you are here to bring clarity as to how we do crypto taxes right this year.
We should just mention real quickly, if you're somebody who finds yourself in a spot where you don't want to be, you haven't reported things, it's uncomfortable for you, especially if it's a significant amount of money, just go to my website, cryptotaxaudit.com, schedule a private consultation right at the top of the web bar, and we can talk about your situation and how to move you from where you're at to a better place.
So. Absolutely. And I'll put that information in the video notes so people know how to get in touch with you. I'm going to jump right into some of the questions that I know people want to learn more about. But first, this is going to be a whole school session. You're going to be the professor, and we're going to do a quick, we're going to do a quick Crypto Tax 101. Can you start us off with kind of explaining the state of crypto taxes? I know you started back in 2018. When you look back, how was crypto taxes dealt with then, if any, and how is it now? And have we made any progress?
In 2014, the IRS came out with a notice which declared that cryptocurrencies are to be treated as property. Now, we have to report any income we make on our tax return. And when you have property, you make income when you sell the property. You bought it for one price, you sold it hopefully for a profit. That profit, that increase, is a taxable amount. So that's how cryptos are taxed. And what happens is not only at the end of a year, we sum up all your gains and losses, because sometimes we sell for a loss, and you come up with a net gain or net loss. We'll just call it a net gain for simplicity purposes. And that amount goes onto your tax return. And typically, if you're trading short term, it's taxed just like ordinary income would be, like your payroll, except no Social Security. But if it's long term, that is, you held the asset more than a year before you sold it, then the tax rate is lower, usually 15%, which is attractive. So that's a rough overview. Now we get into some of the confusion. A lot of people think that with cryptocurrencies, I'm only taxed when I take it to cash, when I move it to my bank account.
Yes.
This is very common, right?
Yes.
And you and I were talking before, like with an IRA, you only get taxed when you take the money out of the IRA, right?
Absolutely.
So this is a very common misunderstanding. IRS has done a very poor job of educating the public on this. Anytime I sell, exchange, or dispose of my ownership of a cryptocurrency, that is a taxable event. That's subject to a gain or loss. So it does not matter what I gave up that coin for. I could have gotten another token. I could have gotten a stable coin. I could have gone to fiat. It doesn't matter. what you went to. The fact is that you no longer own it. And that's what causes the taxable event.
Okay, so hold on. So all the and I ask that because you and I both know we do crypto transactions, especially when I'm rebalancing my portfolio or I'm swing trading. These transactions are happening like this. I mean, I am doing at some days I'm doing 20 plus transactions. I don't know what people are averaging out there. So I'm paying taxes on essentially on every one of these transactions, even
Yes.
though I'm not pulling the fiat out and transferring it into my bank account, my centralized
Yes.
bank account. Wow.
Yes.
Wow. Okay. I didn't know that. I,
There was a law called like kind exchange, or Section 1031, which was in force up through 2017. And the tax law made it very clear it did not apply to cryptocurrencies. Like kind exchange allowed me to go from one crypto to a crypto, another crypto, and only pay tax when I went to cash on the final crypto. So that was in place before then. And some people, experts do disagree on whether that applies to crypto. I happen to believe it does. But from 2018 on, it's exactly as you just said. Everything's taxed. And
wow.
that's a hassle. I mean, that's a really hassle. I mean, the first guy I defended in an IRS audit, I was talking to him about his trades. He said, Clinton, I really don't remember. I was usually drinking a lot of wine at the time I was doing my trades.
Or we're half asleep at 3 a.m. just because we don't want to lose I don't know, a pump or something, and we're just halfway asleep. Who's keeping track? I hope the exchanges are, which kind of leads me to my next question, because we also know there are DEXs, there are decentralized exchanges like Uniswap and PancakeSwap. So what if people are just transacting on those exchanges? I'm assuming the moment they bring it back into their US wallet, then it's accounted for, right? How are decentralized exchanges dealt with here?
Okay, great differentiation between centralized and decentralized. By centralized, we're talking Coinbase, Kraken, these guys. Decentralized, we're talking MetaMask and based type of environments, right against the blockchain. Now, with centralized exchanges, most of the centralized exchanges keep a transaction history, which you can download later as a CSV spreadsheet file, or using an API key, automatically download them into some tool. When we get over to decentralized, there is no central body tracking the history. It's all written on the blockchain. Now, that sounds like a great thing, but when we do our next show, we'll find out that's a very disturbing thing. And from when we are pulling transaction history from the blockchain, we have to read it right off the blockchain. Here's a big difference. When I'm doing a centralized exchange, like on Coinbase, I buy Bitcoin and I swap it for Ethereum. The exchange records the fact that this much Bitcoin was given up for that much Ethereum, and the date and the time, and rough US dollar value of it. But on the blockchain, we don't see that because, first of all, you're generally not doing cross-chain switching. The switching that you are doing, it shows this USD token went out and this other token landed on my Ethereum blockchain. And they're not necessary. There's nothing in the blockchain that connects these two events. And this becomes more estranged as we go into DeFi type of smart contract driven transactions, where things are happening without correlation. There's no correlation between these entries on the blockchain. So when we pull the blockchain records into a online gain calculation tool, it's much tougher with decentralized, because you have to connect the dots and you have to identify this was a taxable event, I gave it away to somebody, or this is non-taxable, this was a transfer in from my own wallet, that kind of thing. So that's a big challenge. Much easier to do if you're on centralized, I will say that.
Of course, but even on centralized, do I hear that it's not just Congress that's responsible for keeping track of these transactions or figuring out how to keep track of these transactions, which they're far from that. But are you saying that the blockchain, in a sense, is also responsible for having some of that knowledge that can be kind of turned over to them?
Well, in the tax code, section 6001, the taxpayer is responsible for proving all his expenses.
Right.
So where is your proof? Well, it's written on the blockchain. The challenge is that there's nothing in that blockchain entry which says why it was written there. All right. An example, this is a great example, especially if someone who is buying NFTs, say art NFTs on like OpenSea. I make a bid for a particular piece of art. So an ETH goes out, right? So that actually gets taken, it goes into a wallet, an OpenSea wallet. Next day, I increase my bid one more ETH. Third day, I increase it again. So there's 3 entries. They're all going out to this wallet. One of 2 things happen. If I win the bid, then an NFT lands on my ETH blockchain, but it's generally coming from a different wallet altogether. So there's no connecting these 4 events. Or I lose and I get my ETH back. That may possibly come from a different wallet address altogether.
Right.
So when the IRS looks at that, there's nothing in the blockchain that persuades the IRS that you just didn't give away 3 ETH to somebody and then somebody gave you as income 3 ETH. So they might consider all of it taxable events because the blockchain does not tell the story.
Wow. We can go down a rabbit hole here, and I see us kind of going down the rabbit hole. But you know
It
what?
can get ugly.
No, it can. But I'm putting here in my notes because this kind of brings me to the idea of CBDC and the control and the transparency that CBDC will have behind the scenes and how that would apply. But that is a whole different conversation. I'm putting it in my notes because I do want to know where you stand on that to be had in future conversations. But I
It'd be a
want to
great
take
topic.
yes, absolutely. But I want to take us to the DeFi sector and talk about liquidity pool staking, farming, and the significant yield returns on investment that we are all collecting. I am always wondering how in the world is that going to be accounted for? Will you please educate us on that?
Oh, that's a great question. When we get into yield farming and these sorts of transactions, these are very sophisticated. Even in the stock and bond arena, these are very sophisticated type of investment tools. They're called derivatives. And the tax law is very specific about the taxation of derivatives when they occur on a regulated exchange. All right. Well, there are, MetaMask, none of these are regulated, so it doesn't apply. And then we get into, okay, those laws don't apply, but we still have the base law that anytime you experience a gain from property, it's taxable. Well, how do I know how much that is? Especially if we're looking at valuations that are changing multiple times a day. We get into, you could look at it at 2 levels. One is, let's call it the microscopic level. Every day, it's rebalancing your stable coins that you have in there and the non-stable coins. You could be looking at rewards that are spinning off on a daily basis. And this would be very complicated there's so many transactions, it's hard to connect them all, right? And it'd be exhausting. Another way to think of that from a tax point of view, the tax code has this concept called a financial instrument or a contract for investment purposes. Think of it as a box, and like a yield farm, it's a box. There's a lot of things happening inside that box. I move in some coins, I move in some DAI and some ETH. All right. And, weeks, months later, I take DAI and ETH out in a different balance. Some of those DAI and those ETH may have been ones I put in the beginning. Therefore, I'm getting back my same coins. So if I put in 10 ETH and I get back 12 ETH, 10 of those were my own ETHs. I really didn't have any gain on that. They were just, I lent them and I got them back. There's not a taxable event there. I didn't dispose of ownership. But I did get 2 new ones. So that 2 new ones are income on the day that I receive them. Or I had put in 1,000 DAI and now I get 900 DAI back. Well, I had a loss of 100 of my die. So effectively, I sold 100 at whatever the prevailing price was. That's one way to look at it. And maybe I got some rewards spinning off somewhere. And those would be on the day they become available to me at the fair market value in US dollars, then that's income. But it's a whole lot easier for us to think of the box approach in terms of making sense of all that activity. And that is a concept that the tax code has in it.
Wow, that's just fascinating. I mean, I know some of the liquidity pools that I'm a part of, are in the Solana ecosystem or ADA ecosystem. And, I guess until I take my earnings from that liquidity pool into an exchange like crypto.com or Coinbase, and they just sit there and gain and earn and earn and earn and accumulate, there is really no way for the IRS to kind of take account of that until it comes to these exchanges, correct?
Yes. Now, just to be clear, this is my opinion. Okay. Other people may disagree, but when I look at a yield farm, I lent, or I put my assets into a smart contract. It's not an institution, but it's a smart contract, which is doing that work. And I expect to get it back. Hopefully get back more than I put in. And since I am expecting to get it back, there's no change of ownership potentially. So that's my opinion. A lot of other guys differ on this area. Ultimately, I don't think you've realized any gain until you actually are able to pull your assets out. So right. It's complex. I think the IRS is trying to avoid any court cases involving this right now. That's my opinion.
Okay, good to know. Let me take us to Web3. And you kind of mentioned NFTs and OpenSea. I want to talk about these economies that are being created in the Web3 space. My focus in particular is very much in this space, because I believe when it comes to the metaverse and gaming, what I love about this sector is that we put the game in the forefront and then the opportunity to earn, right? And we have these economies that are being built and created where people can watch to earn, listen to earn, play to earn, where they have the opportunity to invest in in-game assets and trading those assets, right? How does the IRS look at that when it's part of the game, or whereas, within these environments, economies within the metaverse? Is it the same concept of what did you earn and then you report on that? Or how are they looking at in-game assets and in-game economies?
On one level, we're really waiting on Congress to come up with a better set of tax laws for cryptocurrencies. In the meantime, the IRS is forced to apply tax concepts and laws, most of it framed in a traditional, financial environment, onto cryptocurrencies. And what happens is there's a lot that gets lost from the theory to the application. For example, the IRS's opinion is on those things is that every time I dispose of some asset inside the gaming environment, that's a taxable event, or whether it's either a gain or loss, and it's a taxable event. Of course, the difficulty gets to be, well, there are no tools out there that can read all those transactions off that, say, proprietary blockchain like Axie and make heads and tails of it from a tax point of view. There are no tools. So where are you left as a taxpayer? Well, you have to step back and go with the financial instrument concept that I gave you before. The whole game is a big box. So I moved money in, or maybe it wasn't some money, maybe it was ETH or whatever the units of entry is. And I have withdrawals. And at some point in time, when the withdrawals exceed what I put into it, it's now all pure profit. So that's a simple way, I think, as a taxpayer, we can understand it. It does have basis in the tax code, and there's no other practical way to make heads or tails of it.
Wow. There is so much to be done. Really, we're still very far from getting this right. Right.
Oh, hey, tax. Nobody likes taxes. It's the last thing they implement, and they implement it because they got regulated by the SEC or somebody, right? So these games, a lot of these games, you can't even export the transaction records, or the transaction records that do get exported are insufficient amount of detail to make heads or tails out of what's happening. You might see, I got a magic sword. It cost me 45,000, and I sell a magic sword, and I got 47,000. Was it the same sword? I don't know. What date did it happen? Don't know. Was it long-term or short-term? Couldn't tell you. The records are just useless, like OpenSea, Rarible. These guys have horrible transaction records. You can't make heads or tails out of them from a tax point of view. So yeah, we're in a gray zone. And this concept of financial instrument, I think, will help people to think bigger and maybe even take paper notes. Like, okay, I'm interacting with this game. How much did I move in initially? How much did I take out as it happens? And then that gives me a rough idea of what that game meant in a financial point of view.
Of course. And I think also what makes it even more complicated is that crypto and Web3 spaces are borderless, right? So a lot of these metaverses and gaming companies, they're not even in the US jurisdiction. There's another dilemma of, asking Alluvium in Australia, right, to hand over the transactions for all these earnings that happened on their in-game assets. I mean, I don't know, but I'm just thinking what is making this more complicated is the borderless Web3 space that we're going to try to put some type of boundary within the financial infrastructure. So good luck to the Congress.
Good luck. There are ways to make that happen at an international level, but the machinery is slow.
Yeah, I can imagine. Before we start to close, I do want you to shed some light on losses, because that's always been my question. I am sure there's so many people out there who are wondering, hey, I had a portfolio. I built my portfolio up to, I don't know, $30,000. I lost all the $30,000. I rebuilt it back to $30,000. And this is my second bear market where I'm back down to zero. What do I do here? I gained, but I lost. So what's my position and stance here?
So I had a client call me up. He's a doctor. He said, Clinton, I got a problem. For the year 2020, he made $1 million. He goes, I don't know how to pay taxes on $1 million. That's a staggering amount of money. And I said, well, how long have you been trading? Finds out in 2018, he had a loss of $400,000. He never reported it on his tax return because he didn't want his wife to see it. All right. So, because she signed it, the tax return, so he didn't report it. Right. And he felt it's gone. What can I do? Second year in 2019, he lost 600,000. Again, didn't report it on the tax return. And now he's got $1 million gain. I said, I got great news. We're going to go back and amend those two returns, declare it all, and it's going to completely offset all your taxes. You won't be paying any taxes. He goes, you're kidding me. No, this is exactly what happened.
Bravo. So yeah.
Nobody likes losses, but there is a silver lining, and you want to record and get all the credit out of your losses. Generally, they're going to offset equal amounts of gains. So when we calculate your gains, when I use the word gains, a negative number is also a gain, if just for conversation's sake. So I have winners and I have losers. We add it all up at the end of the year, and it comes up with a net gain, hopefully, but you might have a net loss, especially last year. Have a net loss. What happens then? Well, when we have a net gain, it goes onto my tax return. It increases my adjusted gross income. I get taxed at my marginal tax bracket. When I have a loss, the Congress has limited how much loss we can claim. Right now, it's $3,000. So let's say you lost. Let's say for my client I told you about, he lost 400,000. He can only claim a $3,000 reduction to his adjusted gross income, leaving him with $397,000 of what's called capital loss carryover. You carry it over to the next year. In effect, the next year you start out as though you already lost 397,000. So the first 397 you gain would be, tax-free, so to speak. Well, in his case, he then lost another 600,000. He could reduce his taxes by 3,000, which is his limit. The remaining 597 he carries over. Now you get to the other loss. So now you got both years' losses. He's got $9,904 $1,000 of loss, And then he reports a $1 million gain. It offsets, it shows up as a $6,000 gain that he reports on his tax return, and he gets taxed on the 6,000. So that's loosely how it works.
Wow. Wow, wow, wow. Thank God you are here.
Well, let's
Because
tease it out a little bit more.
yeah.
What if I bought a coin and the coin is worthless? It was a rug pull. It was a scam. I can't prove it, but it's nothing. Yeah, you could go look on, CoinGecko and still find the coin. It's worth 0.000001 cent. Hardly anybody's traded it. It's worthless. What can I do with that loss? Well, you could treat it as a worthless asset. The way you do that is you treat it as though it was sold for $0 on December 31st.
Mm.
And you can, rescue the loss. And of course, losses offset gains, so you don't have to pay as many taxes. Now, the really big thing we want to talk about is Sam Bankman-Fried.
Losses lost on a whole nother level. Yes.
This is Sam Bankman-Fried. If you had a loss through theft, and it could be, and all we have to do has to be a theft. That means it's taken. It has to have been taken for criminal intent. All that we need to show due to Revenue Procedure 2009-20 is that that there was an indictment either in state or federal court by the government of the promoter of that situation. In this case, Sam Bankman-Fried was indicted in 2022. Did you lose assets in FTX? You can now claim a theft loss deduction on those. What is a theft loss deduction? How's that different from a capital loss? The capital loss has the $3,000 loss limitation, which is that's some people's rent for a month. That's nothing.
Yeah.
All right. So, but now when it's the theft loss, I can treat it as a itemized deduction. This goes on Schedule A. There's no limit on how much I can itemize if you're someone who's itemizing. And you can possibly bring your taxes down to zero. I had one woman, she lost $140,000 to a scam, and the guy was indicted on cryptos. She only made $90,000. So the $140,000 deduction brought her taxable income right down to zero. And the excess, the $50,000, rolled over to the next year as a net operating loss. So the first $50,000 of income was tax-free. That's a really nice benefit for having had a loss, and you get to claim it in the year it happened, and that's really big. If you just only lost, a few thousand on FTX, don't get worked up about it. If you lost 30, 40, 100,000, now we're into something. This would also apply if you had invested on BlockFi. BlockFi accepted a $250 million funding arrangement from Alameda Research, which, when it found out that it was fraudulently offered, BlockFi went into bankruptcy protection. But since it's linked back to this fraud, I can claim the theft loss deduction in deducted, large investments there. This is possibly true for Celsius for next year because of Alex Mashinsky was indicted. Do Kwon alleges that Sam Bankman-Fried was behind the collapse of Luna. Now, if this is the case,
now
it's not proven, but that could apply.
Yeah.
So, Sam Bankman-Fried, it was like, he had like the Midas touch, just dirtying everything from a tax point of view.
And we're going to sacrifice him for all these crashes. That's what's going to sounds like it's going to happen.
It is. It's going to be a great, it's a nice compensation. Let's just put it that way. This is called the Bernie Madoff Ponzi scam exemption. It doesn't have to be a pure Ponzi scam though.
Yeah. And how incredible it is to hear you kind of bring clarity and giving us the other side, the perspective, actually our blind spots. These are all our blind spots that none of us have knowledge or know about. So thank you for opening our ears and eyes to this perspective. And I can see that anyone who's spending probably over, I'm going to say 30, 40, $50,000 in crypto, or invested over that, maybe over 100,000, let's say, they need to start looking at what you're talking about and their losses and consult with someone like you. So that's very important. Thank you for sharing that with us. I want to start closing us, but how I want to close this is, okay, well, we now understand how crypto is taxed, I think. And we understand now how IRS looks at our transactions on the exchanges and our earnings from liquidity pools and in-game economies. But Clint, what do we do now about the past? I always say you don't know what you don't know. So are we going to be punished for how we did things in the past? What do we need to do this year as we approach in April, the tax season?
To prepare for your taxes, you should calculate your gain. There are a number of online services that will calculate your gain. They're not all easy to use. And if you're in the decentralized trading realm, it's going to be a significant amount of individual labor. You may use those services. If they come up with a number that in your mind is ridiculous, don't believe it. Just go on, try a different service. Worst case, and we have a lot of customers that have to do this, they make a good faith estimate of how much income they made, and they report on their taxes that good faith estimate. And when you do that, you know that you're paying an honest amount of taxes for the honest amount of income you have. Under the tax code, we have to make a reasonable attempt to report our income. But as we've talked about, this may be an impossible task, especially for a DeFi trader or someone who's done something very complicated. But you should at least make an estimate and report an estimate and pay your fair share. And you should be able to sleep well knowing that you've done a good job. And, I'd recommend becoming one of our audit defense members, because then if you get audited, I'll defend you. I'll recalculate the numbers, and we'll fight the battle for you. But that would be, especially for the types of your audience, they might need to look at that sort of estimating. We do have on our website, we have a tax estimation tool. I think the URL is cryptotaxaudit.com/tax-estimator. Or it might be _estimator. I think it's -estimator. And it's free. You search around, it's just a tool to help you estimate your taxes. Just for everybody, your taxes should be paid by April 15th. You can file an extension, which is an extension on the amount of time to file paperwork, but the money itself is due on the 15th. Any amount you don't pay, you do owe on the 15th, you're subject to failure to pay penalty, and an interest rate works out to about 1% a month on the amount you didn't pay. So it's okay to take more time to calculate it, but try to pay it close to the right amount by April 15th so you can minimize your extra charges. Interest rates are going up. So
great to know. It sounds like nobody's going to jail for not reporting maybe their Shiba pump. But hey guys, if you're out there and I think the IRS, it sounds like, looking for tax evasions and big transactions. But at the end of the day, you need to be honest if you don't want to get in trouble. We're going to get into tax evasions next week with Clint, but we are running out of time here. Clint will be back next week to talk to us more about the topic of crypto tax crisis. In the meantime, Clint, I know you said this at the beginning of the show, but tell the viewers one more time your website and how they can get in touch with you.
My website is cryptotaxaudit.com. If you got a question, you want to talk it through, book a private consultation with me, and we can discuss your situation in a private manner. And I wish you all the very best. As I tell all my clients, taxes are sexy.
Taxes are how are taxes sexy? But you're making it sexy. we're gonna find out how Clint thinks taxes are sexy. I'm gonna ponder on that. I just know you can't escape death and taxes. That's my slogan. But hey, Clint's slogan: taxes are sexy. Clint, it was my honor and pleasure to have you on the show today. I want to thank you for participating and educating us. It was so great to have you on the show today.
Thank you.
We'll be back next week. And thank you guys for joining us on the latest episode of Metaverse Express Full Stop. I'm your host, Mona. Until next time.